Live. And good morning to everybody. Thank you very much for joining us today on Behind the Markets, the Wednesday edition, what we call Wealth Wednesday, where we touch into the midweek point. Today, we're going to be talking a lot about some deep diving news as we go after market analytics and data. I'll share with you a few charts, especially from the Treasury Bill auction from last week. We'll be going deep into that. And finally, Vernon, we're going to be talking about our conversation today about asset selection. So we're going to be going into different kinds of assets this week. I'm going to kick off a series on different kinds of assets and assets that we can be selecting and how you can invest in them, how these things are performed, why we would select them, what role they would play in your portfolio. But before we do that, people, let's get into this week's market roundup. And I would say a good morning to Vernon, but I think we'll catch him when he just gets back in. It is Wealth Wednesday, 7th of June. Now, let's kick into it. We do see that the Kwacha is down again for the 32nd day consecutively, down 0.6% as of yesterday, 10.07% year to date. So the Kwacha has cracked through, the dollar has cracked through the 10% mark. Against the Zambian Kwacha. It is still in a buying posture. It is slightly showing signs still of being overbought, but still we're in negative territory until we see we're in negative territory of the Kwacha versus the dollar until we probably see a resolution to the debt deal. No movement in stocks yesterday. We've seen that stocks are still up 11.6% year to date, while the bond market moved up the standard 0.6% and shed off 0.53% against US dollars. While we did see interest rates drop for the third consecutive day, showing still signs of buying on the market. Remember, we are seeing that interest rates on the primary market a little bit higher than on the secondary market at the moment. Now, we also are paying attention to the fact that we did see that the Rand has continued upwards on its trajectory, putting a little bit of inflation pressure on cross-border trading, up 0.85% as of yesterday, with the dollar up, as you said, 10.07%. Acceleration is showing the positive as well. So you can see that the dollar is even accelerating, and also the Rand is also starting to accelerate. Now, not on the highs of 1.16, but still of 1.033. Now we are seeing that 70% of the last trading days, even for the Rand, have been positive. As we said, that is probably bringing in a little bit of potential inflation pressure. While we're seeing that year to date, bonds are up 11.72%, down, only up 1.49% in dollars, with interest rates up 0.48%, obviously with that pushback up, but interest rates are still trading above 24.1, at around 24.12. So we are seeing that bonds are still elevated in terms of interest rates, and we'll be going through the T-bill auction to show you where we stand on some of this right now. Now, commodity markets, we did see that copper was down 0.2%, oil was down 0.76%. As we're seeing some signs of oversupply on the market after that push by Saudi Arabia to try and reduce output in terms of oil. Gold was up 0.08%. It seems to be wavering around this debt ceiling talk level. It seems to have gotten stuck there, but up 8.16% in dollars, while both copper and oil are down, showing the weakness of industrial data. Plus, we're also seeing bad data coming out of China in terms of exports. That's set to push oil and copper down even further. We did see that the wealth insurance assets yesterday, negative plays in cryptocurrency and in Ethereum. Bitcoin down 2.3%, Ethereum down 0.8%. But year to date, they're both up 72 and 68% respectively. The gold is up 19.05% year to date and up 0.68% in Kwacha. So we are seeing that wealth insurance asset is the gold token or gold itself. Now remember, you can access gold through tokens. There is tokens on the crypto market. The two most credible ones are Tether and Paxos, because those are actually registered financial services firms which actually have gold backed in London Metals Exchange vaults. So these are actually certified. Currencies or certified tokens of gold, and the cheapest way to actually access gold. Now we are also seeing that. We also are seeing across the board, as we said, in year-to-date data, bonds up 11.7%, stocks up 11.6%, gold up 19.1%, with the crypto and Ethereum assets up 72.5, 69.9. The red bar showing what it is in real terms when we adjust for inflation. But we are seeing across the board that the market is still in a defensive position. And finally, before we get into some of our deep diving data today, we did see that yesterday was packed full of negative news only. European retail sales fell flat while remaining negatively year on year. South African GDP activity down 0.2%. Up 0.2%, which is a much slower growth rate, while the US Red Book grew to the slowest level since the pandemic level started. So this is basically retail level sales in America. Chinese exports declined by 7.5%, with imports declining 4.5%, showing weakness in the Chinese economy. European construction PMIs are deeper in construction, I think, except for the UK. And we also saw Canadian building permits declining. So this shows softer growth. Weaker growth is going to be the order of the day. So that is where our markets are standing. We'll be back on the other side to give you our deep dives into the news, our analysis of the Treasury bill auction, and finally, our topic of discussion on asset selection. Catch you on the other side.
And we are back at it.
Thank you very much, and thank you very much for joining us back, Vernon. As we're saying, yes, as we touch back in, we did see that our four horsemen are showing us not much news in inflation and interest rates, but we did see weakness in the international trade picture or international growth picture, while we also saw weakness in industrial demand. So. This is not good signs for the copper stocks in the intermediate, but I have braced people saying copper in general is not going to do good in the short term, but in the medium term, we will start to see it reverse. We will start to see it reverse course when the EV acceleration kicks in. Now, in terms of our daily deep dive yesterday, we did see that Pomozi Hotel earnings per share are up 113%, primarily attributable to an increase around 109% in revenue due to the increase in the room segment, the banquets, and the restaurants. So obviously, Pomozi has been a recipient of the global tourism recovery. We did see 2022 recreation and hospitality and accommodation GDP sectors recover very strong as well. And also, obviously, as the pandemic has calmed down, we also have seen we also and the post-pandemic recovery, we have seen things like weddings returning. Brothers were trying to sneak in those quick weddings. Remember when they said no more than 50 people? All of a sudden, you notice, Vernon, how many guys were popping the question around the time that wedding sizes got limited and there was no hotel weddings. All of a sudden, that guy who didn't want to marry you, who was busy wavering around on the decision, magically decided that he was in love with you and wanted to spend the rest of his life with you. That shows you the power of the barrier of the wedding. That was the barrier that is. Because I was switching on my social media feed, and every week, no, this one has gotten married. We finally popped the question. We did it. That guy just needed to make sure that the wedding was confined to 10 people, and you had no choice but to go to Civic Center with him. Ladies, it shows you how this works, the economics behind marriage. But yes, Pomozi has actually been one of the main recipients. What we've also seen, by the way, is all these conferences, these global conferences that have been happening. The hotel space in Lusaka is also limited. So as you've seen, Pomozi Hotel PLC also was a beneficiary of all these dignitaries staying in these hotels because that's where they could stay. So I think this is also a sign that as we're seeing the global tourism sector and the conference industry in Zambia still rising. Remember, we were talking about IATA data yesterday, where we were seeing flights into Africa are actually picking up as well. Though profitability may not be as high for the airlines, but flights into Africa are picking up as well. So this is a sign that we're going to see a lot more activity in this stock, in this company. Now, it isn't a liquid stock. It doesn't trade as much, but you can see that the profitability of the company will start to pick up. We'll be waiting for the financials to kick out probably today. We also got news yesterday that RTSA approved a 1 kwacha reduction in bus fares for local routes in Lusaka and Copperbelt. Intercity routes also were pushed down by 5%. This follows the largest reduction in diesel, the largest diesel reduction and the second largest reduction in petrol, both by 11% since the commencement of the monthly reviews. Now, the question that still stands is, will this be able to be sustained? We are seeing signs of oil prices already kicking up on the global economy. And our exchange rate is pushing up. This is already putting pressure for an upward adjustment this month as it stands, unless we start making sure these structural changes, maybe, but it is looking like there's still pressure, and that will reflect in transport inflation probably 2 months later. So we still have 2 months of lower transport inflation, but we're already seeing pressure pushing prices up, especially with Saudi Arabia now saying they will go at it alone if they have to cut production to increase prices. So as much as there's a bus fare reduction now, that should bring transportation costs down slightly. We might be seeing the reverse probably in a couple of months, if not by the end of this month, because of what's happening in terms of the price of things. This is why, Vernon, I've always been a proponent for saying, I think one of the things we really, really need to consider when it comes to bus fares in this country is I think we need to come up with a formula and a basic formula so that it can be predictable to a degree, and not just something that's always at the whim. Because it's very difficult to try and get these things to come down when they're not systematic. So I've always suggested that the formula should include the FX rate because of wear and tear based in dollars. It should include the price of fuel, and it should also include the inflation rate, the monthly inflation rate, because the drivers are human beings who are going to actually need to operate and exist in a world where if the prices go up, they actually have to feed their families. And if we take these three factors into consideration, the FX rate, if we take the consideration of the FX rate, the fuel rate, and also the FX rate, the pump price, and also the CPI, we may actually find the monthly CPI. We may actually find an equilibrium in being able to create a calculation as opposed to a deliberation, because people don't know where the price changes often come from and whether there's a set calculation. I think that's something we need to start thinking about. Now, some people don't like it because I've seen the response. People say, yeah, but if things go up, then the price will go up. Yes, that's how systematic things work. Would you rather have something that you can predict and foresee, or would you rather have something that's always at the discretion of people you've openly said you don't trust? Okay, you've openly said you don't trust the system. So why not make it just a straight calculation? A simple, straight, down the line calculation so that people can just stick with it. I think that's something that we should start bringing into consideration in the years, probably as a way going forward. Now, one of the things that we do actually see going forward. Sorry, one of the things that we are actually seeing in terms of the deep dives on the news, and we will actually read some of the comments coming down, is also the vegetables and the Fruits and Vegetables Trading Association did actually point out that onion shortages are attributable to low production of the commodity. Since the nation is no longer importing onions, we are actually seeing that local production is not sufficient for growing demand of the nation. And this has been part of the nation's drive to promote local production to increase job creation. Now, this is something that's quite important. Now, there is a battle here. This is why I keep saying the middle class doesn't like inflation. The lower income group, the working class, they want job creation. So there's a battle now. We're starting to see the tension between inflation and job creation. And this is why I keep saying when you're a poor nation or a nation that is actually categorized as poor, your number one priority is to bring jobs to the market. Because you can have low prices for things, but if people don't have money in their pocket, even if a tomato is one kwacha, if a person does not have a kwacha in their pocket, they will starve, they will get frustrated, and they will react. Okay, I'm not saying you should just let inflation run away, but job creation is the priority. Number one risk that has been categorized actually by the World Economic Forum of Zambia is unemployment and underemployment. That was from 2015 all the way up to 2020. They had ranked unemployment and underemployment as the key risk of Zambia. Inflation actually came in as number 5. Okay, before that was poor governance and also energy shocks and poor urban planning due to things like cholera outbreaks and poor sewage and poor sewage and drainage. But the number one risk is unemployment. So whenever you're trying to see the things like onions, people need to understand it takes time for this country to catch up. I know there have been complaints about the quality of onions, the size of onions, all sorts of things. But if the middle class cannot bear a little bit of pain in the interim, what's going to end up happening is you're going to end up frustrating the lower income who are going to end up voting in a populist again. And then you're going to complain saying, this bad governance, they have brought us into debt, they brought us this, because you're not being considerate to the fact that jobs have to be created through the things you consume. See, this is the problem. Everyone wants job creation, Vernon, but they don't want it at their cost. You see, they don't want to have to bear any pain for the actual act of job creation. Here's what you're going to have to understand. Poverty alleviation is going to cost a little bit of inflation. Everyone is going to have to get on board with that. Otherwise, you are going to have to accept a poor country. So you choose. What do you want? Do you want poverty alleviation and wealth creation? Because wealth creation does require some inflation. Do you want wealth creation, or do you want just things staying exactly the same? Because you can't get both. Even in China, things used to be dirt cheap in China. Guess what? The Chinese got rich. The workers started demanding higher salaries, and as a result, things got more expensive in China. If you read the book on Nike, you know what you also start to find? When the Japanese economy went up, the price of Japanese exports went up because the labor unions were demanding higher wages, because they were saying we're producing a lot and we want higher wages. So the result is, if you want to pull a lot more people out of poverty and into affluence, you are going to have to stomach the idea that there's going to be some short-term inflation. What you're going to have to start learning to do is becoming revenue aggressive. You are going to have to find ways to earn on performance, earn on commission. You're going to have to find alternative ways to splinter your income. But you are going to have to start learning to not just try to defend what you're earning right now, but to learn to push yourself to earn more and gain more. That is the way that society is going to have to operate if this country is going to improve. Because this battle between inflation and job creation is going to cause a problem in how policies are being dished out. And you can see the tension right now in the price of onions. The middle class are demanding that we bring back the imports of onions, But on the other side, the working class are saying we need this so that production can increase. Because if the price of onions remains elevated, more people will plant onions, which means more workers, more people will be able to sell, which means a bigger market. So the shortages are actually going to stimulate production in the medium term. But if the government intervenes and allows this to come back again, unfortunately, we're going to face a situation where the shortages will not incite production, and we will have the situation where our onion market is constantly going to be flooded by offshore onions, and we're not going to get onions being produced inside Zambia with Zambian hands, with Zambian labor and product. So whatever's on your plate needs to be locally produced. Whatever is in your house, as much of what's in your house needs to be locally produced for you to be able to develop as a country. Do you get where I'm coming from here, Vernon?
Indeed, I'm following. Yeah, I think the whole thing of supporting local, and then we're not producing local, then we are beating the narrative already. If we're not going to support something that is not there, so more manufacturing of local stuff will really encourage that we can have more, and less of more imports rather, but have something locally produced and more products actually, especially when it comes to food items, especially locals like agriculture, vegetables, grain, and things like onion, which is now of course reportedly that there's a shortage. I think we should be having these locally produced by our local farmers.
Yeah, so it's look, the point is to make sure that local hands are making things. The thing that destroys economies and societies, people, it's also a social risk for a small, select, affluent group to live foreign lives. It's a social risk. You create this fracturing of society. And it plays out in Zambian policy development. The reason why we don't have stable development policy is because there's this fight between populism and professionalism. There's this constant fight between the two. And as a result, the populists want to be pulled out of poverty. The professionalism are trying to then preserve a certain thing. Now, I think we're trying to have a middle ground here. So this is why when the populists mess things up, the professionals have to come back and clean things up, but then inequality starts to breed again because the policies tend to favor the middle class only and not the working class. So you need something that has protectionism in some industries, because this business of flooding markets with foreign products is a problem. Okay, it actually is a problem because it stagnates development, because all that farm work that could be done in onion production, feeding millions of Zambians across the country, is not done. It's then done in South Africa, and therefore we end up importing onions into the country, and South Africa ends up finding jobs, and Zambians are still on the street. And those Zambians who are on the street in the next election, you're going to be saying, but how did they vote for these people? That's how, people. Okay, that's how these elections end up happening, because you don't want to take the sacrifice. So here's what I'm going to tell people now. You're either going to take the pain of onion and maize prices now, or you're going to take the pain of populist policies in the future. You pick which pain you're willing to take. That is your choice as a country. Okay, but you're not going to avoid pain. You can avoid pain now, but you're brewing pain in the future in a way that you will start crying about in the future. Okay, so you pick which pain you want. We can take the pain of slightly higher onion prices and try and maneuver ourselves around it, but to make sure that we're giving people an opportunity. This is the same conversation, by the way, I was having about maize. When the maize growers are saying, we want the real price, not our price to be capped all the time. We want a proper price that we can even export, and we want the rights to be able to start going to other markets. Okay, that's what the local maize growers are fighting for. And it's causing inflation, yes, to the middle class specifically, but they need to understand that those maize growers who are majority poor need the right to pull themselves out of poverty. And if you're not willing to pay for the price of maize that they want, then somebody else has to. Okay, because they have the right to live the life that you have. Or is it only that only your middle class life should be protected, but at their expense? Because now what ends up happening is that your life is what it is at the expense of people who want to live the life you have. But you're capping them because all they have is the ability to grow maize, and you're telling them they have to grow it at the price that makes you comfortable at your salary, but doesn't touch them as well. So this is why I'm going to say to as many people, whether you're trying to work out your work life, your business life, or anything, get used to not roaring inflation, but slightly elevated inflation. it appears the stickiness of 10% inflation might be around for a little bit. And the reason I say this is because we're trying to stimulate growth, and especially endogenous growth. We're trying to stimulate it. So let me give you a picture of what it looks like in terms of things like onion prices going forward. Now, this was data that we captured from the last CPI read, and we found that rape, tomato, and onion prices were up 12% year on year. Tomato prices are up 37%, while rape prices up 20%. We also did see, as you can see, onion prices have moved from 14.69 year to date all the way up to 19.73. So we are seeing that constant upwards movement of onion prices. Rape prices are pretty much stable as they can be. So now, if you could see in the last inflation read, this is actually showing that the food inflation that's happening is mainly being triggered by the vegetable market and partially the fish market. But it's really the vegetables that are leading the inflation charge here. Now, that is a big part of people's ability to make a living. Now, we have to obviously try and see if we can get more and more production. Once there's more production, we can be the ones to start to export. But we have to have a little period of a shortage to then call more people into the market. And it takes time, people. It's not instant. Okay? It's not instant. And that is the reality that we have to face. And that's a little bit of the news on that. Now, in terms of global news, today, Vernon, we did see that the World Bank did cut its 2024 global growth forecast as we're seeing rate hikes bite, but they do lift their 2023 one. They've said obviously resilience in the US and Chinese and other major economies have proven more resilient in their forecast, and therefore they're seeing that the interest rate and the credit tightening that they're seeing in America and Europe will probably take effect in 2024. So they have lifted their global growth outlook from 1.7% to 2.1%, but this is still lower than the 3.1% growth in 2020. So the economy is still going to slow down in growth. Now they're saying 2024 they forecasted growth to be from 2.7% down to 2.4. So the next 2 years the World Bank sees 2.1%, then 2.4% as opposed to 2.7. And they are seeing that obviously these interest rate battles are the main thing that's driving slowdowns in economic activity. Yesterday, Vernon, we read a story that in America, you saw that the hotel developers are struggling to actually get capital for new construction activity because of the increased requirements for regional banks. So they can't even get access to credit. And also that was triggered by higher interest rates. Now, for the crypto traders, the U.S. Securities and Exchange Commission has sued Coinbase and Binance. They've actually charged Coinbase with illegally operating because they have failed to register as an exchange. So they've actually cited that Coinbase should be operating as an exchange. They're saying crypto markets undermine that trust. And I would say that it undermines the overall capital markets. This is the Security and Exchange Chair, Gary Gensler, who told CNBC yesterday. So this is just after they've actually sued Binance for the same thing of issuing tokens without actually registering as an exchange and adhering to the SEC exchange rules. So this is something that even Coinbase lashed back and said, look, your rules are unclear as to what cryptocurrency is. Are we a property or are we a security? Because if we're a property, then you can't label us as an exchange for security. So this is something that's actually quite interesting. It's an ongoing battle and it's going to set the precedent, but it is causing a little bit of a fracas in the cryptocurrency markets. And that boils down our main news stories and our main topics. Our main topics before we go into our topic of discussion. Now we have gotten we have actually gotten we have gotten a few questions here. John has actually asked, how is the issue of fuel to be managed to control prices? Unfortunately, because we don't produce fuel, that's a very difficult thing to do. We can't produce that. We can't control that. We don't produce. So we are trying to manage the supply chain. They have actually managed the direct diesel line. So that's supposed to bring down the cost structurally of transportation. And once diesel prices come down, petrol prices can structurally come down with it. Simultaneously, we are also looking at not just diesel prices. Also in 2026, There's supposed to be the connection with the Angolan refinery. Remember that the Angolan refinery is set to be built in 2026. They are working on the $250 million investment to the Lobito corridor, which is supposed to connect Lobito to Kolwezi. That gives us the opportunity to then connect Kolwezi to Solwezi. And if oil can move from Lobito to Kolwezi down to Solwezi, we get access to Angolan oil, which currently is priced at 51 cents, where if it was in Kwacha, if that was in Kwacha, because that's how it's trading. If it was in Kwacha, it's currently trading at around 17 Kwacha. That is the market price for Angolan oil at the moment. So by the time we actually catch on to that Lobito corridor, we might find if the Lobito corridor gets created and they finish the Sonangol refinery, that actually now starts to create a structural change. So that's the best that we can do as a country: create structural changes behind our oil price. But you can't control the pump price of oil that you do not produce. That's the purpose of companies like Dangote also trying to get into refining, to try and help create an African internal supply when it comes to oil. We've also found that I think John is also saying on onion, also most of it is exported. We also do find that there's also, and I think John's also correct here, we also do find that especially with tomatoes and onions, there's also a market at Kasumbalesa for these things that also drives the price. So food prices are often driven by the export price of traders now trying to trade with Congo, who buy these things at a much more expensive price. So the weaker our currency gets, the more it pushes the price up as well. But once again, I keep saying the higher prices do drive more production as well. And I think you're asking, what of oil in Zambia? Well, we haven't yet. I know there's stories of it, but it's not yet on paper. It takes a long time, people. Even if you discover oil, it takes a long time to start drilling, extracting, and refining. That is a long process. Those are decades-long process that when people do the actual studies and discover oil, to actually start producing it is at least a 10-year process. It's the same with a mine, by the way. When you discover copper in the ground, it takes you 10 years before you actually start pulling it out of the ground and start processing it. So these are not things that can get resolved, even if we actually did find credible strands of oil in this country. And I know everyone says there's got to be oil, but it has not officially been found yet. Okay, it hasn't. It's not official. It's not on paper, and I understand all of that as well. So we until we start producing our own oil, we're not going to be able to actually create. We're not going to be able to have control over the oil prices. That's the reality. We're a buyer. We're not a producer, and we don't have that freedom as of yet. Now, let's touch into the Treasury bill auction from last week for everybody here. Let's break down what has actually been going on in terms of the T-bill auction. Yesterday we did actually grab data from the T-bill auction as of last week, 1st of June 2023. Summary that we did see is that the T-bill auction raised 2.5 billion, 13% over target, and is the first over target raise in 5 auctions. The composite yield did go down due to strong performance of the shorter T-bills, and the risk-free rate, which is a 364-day Treasury bill, rose for the second consecutive time. Lead performers with a 364-day Treasury bill, which was 50% above target, and 66% of the auction. However, the 182-day Treasury bill also saw heavy activity as well, which brought the weighting of the 364-day Treasury bill down. But we are seeing higher interest rates on the 364-day Treasury bill, means that it's something that I could recommend can start to be included in one's bond portfolio, because it is trading at 6% above inflation. But these were the interest rates that we did see. We did see that interest rates on the 91-day did rise to 10% from 9.8. We did see that the 182-day did also come down, while the 273-day went up, and the interest rates on so we did see a rise in the 182-day and the 364-day, but we didn't see a rise in the 91-day and the 273-day. So these were the changes in the interest rates that we actually did pick up on. You can see that interest rates are up, as I said, are up on 182 by 0.1% and 0.05% on 364-day, but the composite rate is down 0.72 because of the stronger performance of the lower interest rates, down from the 15s down to 14.5%. Now, what we did see in terms of Treasury bill sales is that we did see that the sales sales for the 364-day Treasury bill were up 33%, while we saw 1,960% month-on-month movement, auction movement of the 182-day Treasury bill, while the 273-day was up by 176%. So we saw strong performance that brought 65% more sales across the board, and a lot of them performed in the 70% of their range target, except for the 364-day, which is the main driver, up 150%. So you could see the strong composition was still in the 364-day, but its weighting was down 16%. So you are seeing some positive spreading out here. But the problem is that interest rate, or the good for those who want to get involved, is that interest rates are actually rising. Year-to-date sales are also showing, in terms of on a year-to-date position, we've seen that there has been a higher performance in 364-day Treasury bills up to this point, up 9% from this time next year. We have seen that 364-day T-bill has also performed above target for the majority of the year, while the lower ones have performed slightly below target, with the 182-day only 70%. But 82% of the money that's been trying to be raised through Treasury bills has been successfully raised, with 62% of it coming from the 364-day Treasury bill, up 9% from its composition and above 12% above where it's looking in the market. Now, if you're looking also in terms of where the Kwacha is sitting, in terms of where the Treasury bill auctions are sitting, we also are seeing that we saw a higher trade in all of them across the board, or every single one of them performed higher than they did in the last auction, with one of the biggest jumps coming from the 182-day Treasury bill as well as the 364-day Treasury bill. In terms of T-bill auction versus their percentage, all of them also showed higher performance against the benchmark that they were looking for, or the sales target that they were looking for. Simultaneously, compositions actually spread out a little bit, while each of the others went up, with the 91-day up 10%. The 182-day up to 11% from 0.9, and the 273-day up 12% from that point. Now, some of the data I will show you. This is the subscription level. This is the auction performance. So this is what we meant when we said this is the first over performance in 5 auctions. Okay, so you can see the others were below the 100% threshold in terms of funds raised. Now, this one was the one where the funds raised position was 113%. Before, we were at 68, 36, 42, and 52, showing that we had a negative run, but we've started to pick back up. So it's actually showing that money is flowing into that area. Composite yields are coming down because of the performance of the shorter end of the bond market. However, it is a 364-day Treasury bill interest rate, which has moved from 15.75 to 16 to 16.05, showing higher interest rates coming in. So this is part of what we can be doing. And I'm actually seeing even some people putting some money into the 364-day Treasury bill. It is one that I would start to recommend, and saying that rising rates in the 364-day Treasury bill and strong subscriptions in the T-bill auctions show the risk of the conscious investor who's not ready to take duration risk. So they're opting to be in the shorter space. So you're seeing underperformance in the bond auctions, overperformance in the Treasury bill auctions, meaning that people are shortening their horizons until we get past this impasse that we're struggling with in the market specifically. Now, for the wealth investor, I would say there is an opening now to start including the 364-day Treasury bill into your portfolio as well. Should you be one who's maybe doing trying to mix your bond auctions, so you can start putting should you start putting your bond numbers, I would say the 1, 3, and the 5-year together. These are the ones that are performing decently. You are getting an 18% performance around that place in the 2-year bond, but the 1-year, the 3-year, and the 5-year, the ones which are looking definitely attractive at the moment, especially because it's performing 6% above inflation. Now, should there be some interesting outcomes, obviously from the debt talks, we should actually see these interest rates possibly come down. But for now, signs are showing that pressure is pushing up on interest rates. So the probability of even bond auction interest rates coming down are still relatively low. That is our crackdown on this as well. Right. So let's now get into our topic of discussion. I don't know if we're gonna have Vernon back at any time, but let's get back into our topic of discussion, which is today got to do with asset selection. Now, I'm going to give you some characteristics. Partially, I'm going to open up a series here to talk about selecting assets and asset allocations. This is a very big and important topic that we should be going through, but it is going to be talking about what are the drivers of your assets. Now, remember, whenever we talk about things like the financial pyramid, for those of you who are looking at how to invest your money, remember that the base of the financial pyramid is what I call the collart. These are all the systems you need to have in place to be able to invest. Now, the collart stands for cash, assets, liabilities, estate, risk, and tax. Those are the systems you have to have in place to be able to push yourself to build your wealth. So you must have cash management systems, you must have asset management systems, you must have liabilities or debt management systems, estate management systems, risk management systems, and liabilities. So we're starting a series on risk, but on Wednesdays, I really want to allocate this to asset allocations. So Wednesdays, we'll be dealing with this part on asset allocations and everything that can come down to what kind of assets can you be holding in a portfolio and what investment strategies can you be utilizing. But today, I want to talk about what drives people to select investments and basically the asset allocations that they really look for. Now, there's two categories of things that drive people to actually make their investment. And these are, as I said, the asset allocation determinants. And they come in two categories. The first one is financial goals. Whatever financial goal you have set for yourself, be it I want to have financial freedom to spend more time with my children. I want to have financial freedom to be able to travel more. Whatever it is, it's based on your character and values. Your character and values will determine what things you think are important in the future for you to be able to now start making decisions as to what assets you want to have. Because the liability of the lifestyle you want in the future, the lifestyle you are looking for in the future is the liability. You need to build an asset today that matches that. And the lifestyle you aspire to is driven a lot by your character and your values. Okay, so whatever character and values you have, now your character and values also affect what kind of risks you're willing to take. What kind of mindset you have is also important on what you are willing to invest in. So that's part of the equation in terms of that. The second driver is your personal state. Okay, whatever state you are in will determine what financial goals are important to you. Okay, so if you are in a state of calamity, anomie, and your life is engaging in the macabre dance, then you are probably looking to clean things up. So you need stable assets. But if you are in a state where you kind of have things already going and you've been running your investment plan for some time, risk may be something you might be willing to start rolling into. So that's a different conversation. The other thing that affects your financial goals are your aspirations. Do you have certain your property ownership goals will also affect what kind of assets you'd like to have, because that'll also affect how much money you can allocate into certain things, because you need to allocate money to building projects. At the same time, what are the important relationships you have? Are you saying, look, I want to spend more time? I've seen people say, look, I want to spend more time with my son. I've got limited time on this earth and I don't want to go without having a good relationship with them. So I really want to make sure that my time is my choice. Remember that the power of money is not about the things you can buy, but the way you can spend your time. The purpose of money is to liberate your time. Okay? That is the importance. Now, if you don't have anything important to do with your time, you will just start buying frivolous stuff. That's the way it works. But if you have important things you'd like to do with your time before you pass away, you tend to build assets more effectively. This is why I ask people, what is the future you? What do you see for yourself? What is your vision? What's your goal? What's your aspiration? Now put assets aside to support that. So also your current financial situation. If you're in debt, heavily in debt, and it's high interest short-term debt, you can't be putting away money into assets that easily. In fact, you can't do that. The first investment you need to make is clearing that debt away. High interest debt needs to go. Okay, that's the immediate threat to you being able to build wealth. So these are the factors that affect from the financial goals perspective. Then there's also your risk perception. Now, risk perception, number one is your risk tolerance. Vernon, as a person, what kind of risks are you comfortable taking? Are you comfortable taking high risks? Are you not? What gets your BP pumping here? Okay. If you see the stock market, if you see the stocks you've invested in drop in price, how will that scare you? Okay. If not, if you're comfortable with that idea, you have a high risk tolerance. Now, I make people take personality tests and what are called money personality tests. Dave Ramsey has got one called Know Your Money, Know Yourself. I make people take that. While simultaneously, I also ask people to take their Myers-Briggs test because each Myers-Briggs personality has also got a risk profile to it. This has been studied across many Myers-Briggs personalities and risk profiles as well. But you don't just take your personal risk tolerance, Vernon. You also take something called your risk capacity. And your risk capacity is how much time is there between you now and the financial goal you aspire to reach. So the less risk you can take, the less time you have, the less risk you can take, the more stable asset. So if somebody comes to me and says, Munyumba, I want to retire in 5 years, I'm going to tell them shift all your money into bonds because you can't afford stock market risks. You can't afford price movements in your money. Okay, so shift as much of your money into the bond market. Start buying and holding government securities. Okay, and making sure that you're building on, because if you want to have a retirement in 5 to 10 years, you better make sure that most of your stuff is sitting in the fixed income space. But if you're giving yourself 20, 30 years to do something, you can take stock market risks all of a sudden. That's part of the equation that you can do. So your risk capacity is the time between that. Your investment experience. I've also seen, Vernon, that one of the reasons I tell people start with government bonds, I call it the gateway asset. Okay, you know how they call alcohol a gateway drug, that if you start drinking, you're likely to do other drugs as well. So it's what they call the gateway drug. So I looked at, and even for people who are investing in cryptocurrency, Bitcoin was seen as the gateway currency. I call bonds the gateway asset. Because once you get a grip on government bonds and you understand how an asset works, you understand how an asset flows, you understand how it pays cash, you understand how it appreciates, because built into the bond is a structured cash payment and a structured appreciation of the asset. So therefore, you can now measure other stocks. People now start to come to me, and I see this all the time, Vernon. Once they've gone 6, 7 months in, they say, right, Munyumba, I'm now comfortable with bonds. What else can I invest in? What else can I invest in? They start becoming more confident about trying to diversify, especially those who have managed to build out up to above, let's say somewhere around $1 million and above. They start looking for that a lot more. So that's a question you'll start to see as well in terms of your experience. The more experienced you become, this is why I tell people start with bonds. You will naturally become more comfortable with things like stocks. It will naturally flow. But if you try and force yourself to be good at everything from the beginning, you'll confuse yourself. So investment experience is very good. And I often say the bond is a very good starting asset because it teaches you how all assets are supposed to operate. Your income level. I've seen that the wealthier have got the people, let me say the wealthier, the higher earners, because wealth is assets. Higher earnings is income. The higher earners tend to be willing to take a bit more risk. I've actually seen this more. Higher earners tend to be willing to take a bit more risk because of higher levels of discretionary income. Also, the investment goal. Vernon, if you're investing for your child's education, I'm not going to advise you to start putting money into the stock market. I'm going to tell you to put it into bonds or fixed income funds because you're trying to protect that amount. It came from my time as a gratuity manager where I could tell you that gratuities needed to be managed at a specific time frame. So you didn't want to risk it by putting the money into risk asset. They put it into fixed income and they put it into bank deposits with much higher interest rates. Also, Vernon, your safety net. If you do not have a cash reserve, you become very wary about putting money into things that don't grow steadily. So if you've built a good, decent cash reserve that can cover. And then finally, Vernon, your current net worth. A person with higher net worth tends to be comfortable taking a few more risks. Okay, the wealthier a person gets, the safer they feel, the more risk they're willing to take. So, therefore, your risk perception is also affected by this. These are the things that we assess to look at what asset allocations are the best for you. It's a very deep process that most people may not understand. And quickly, Vernon, I just wanted to share this before I share my final thought, is that the key features that Zambians look for in an asset, according to the FinScope 2020 survey, this was data derived from it, liquidity is the number one. Number two is simplicity. This is why I always talk about bonds, is because this is based on the Zambian people's desires. Liquidity, simplicity, and accessibility. The bond is actually the number one asset that fulfills those top three levels. It is something that can be liquidated and it does generate cash flow. It is simple in the way it operates, and it's accessible because the lowest investment is 1,000 kwacha. So that's kind of the way these assets operate for you to be able to utilize them. But you see, these are the assets I'm talking about, the building of assets in a long-term basis. Now, Vernon, the problem is that when people get money, our president seems to have some choice words recently about when brothers get money, what's the first thing they do? And here are his thoughts.
Showing off. Just started business and you want to show off. I don't know who you are showing off to. You want to buy a VX, you want a Beamer. A young guy hasn't worked and you hear the social media buzz is about a Beamer. What is that stuff? You've
That is the Beamer, Benz, and Bentley rap generation. People, a car is not an asset, it's a utility. Okay? A car is not an asset, it's a utility. Stop lying to yourself that it's an asset. It's not. It doesn't appreciate in value. At the end of your life, you will regret it. Okay? Anything that gives you pleasure up front and pain later, trust me, that is not a blessing. Blessings give you pain up front and pleasure later. Okay, that is a blessing. If you're looking for something that gratifies you upon the time you get your hands on it, you are dealing with a curse. It's a future curse, people. Okay, that is a liability. If for it to bless you, it must hurt at the beginning. Then you will feel the pleasure later. Saving and investing is a blessing then. So people, accumulate the right assets. Don't go and throw your money into things like that before you've built assets. I've got a calculation for that. I'll be talking about affordability later. Vernon, Asante Sana, my brother. Asante Sana. And to everyone, thank you for joining us.